Remember, September was a bad month for mutual funds with a net outflow of 2.3 lakh crores, where liquid funds, where corporates typically park the money, worst affected. Other categories like the income funds were also impacted in a big way. So, what's the implication that we can draw out of very high outflows in September versus some staggeringly high inflows in the month of August as well, especially in the liquid category? And now that we've had a couple of days to digest the news, what's the eventual outlook on all of this? Let's get in a very important voice, Mr. R. Sivakumar. He's head of fixed income at Axis Mutual Fund, joins us right now on the show. Siva, good morning, and thank you so much for taking the time out. People that I spoke to on the day of this data coming out mentioned that the number was unusually high, yes, but what's also not happened is that the inflows that typically happen after the outflow at the quarter end have not been that high too. What has been your experience, and what have you made of these two staggeringly high numbers, the outflows in September versus the very high inflow in August?
Yeah, good morning. And you're absolutely right. The number looks very large. And you're also equally right that the August number was quite large. So, when the August number was not really commented on, it does look like what September is just a payback for the previous month. And the net impact of the two is of the order of maybe a 30 or 40,000 crores negative, which is not really surprising given the size of the liquid fund industry. So I think it's normal to see the third month of a quarter seeing outflows. September is that third month. You see some outflows, advanced taxes, and typical quarter end liquidity tightness. And of course, this time we have seen some amount of additional tightness on two factors. One is some amount of credit market issues, and second is, I think, post the RBI intervention on FX, there's been a significant tightening in money market liquidity. So there's been a combination of factors, I think, leading into this quarter, which has led to some unusual tightening. But I think it's not very, it doesn't seem to be very unusual in terms of at least rates. Markets have been reasonably well behaved. And to some extent, what we see in the month of October in the first week or so is, yes, inflows have not been as high as before. Once again, this could just be a reflection of the fact that system has been reasonably tight in terms of liquidity.
Could it be as simple as corporates parking their money in the month of August into the liquid and the credit funds in a big way, then taken by surprise as to what's happened and the pace at which the ILFS crisis unfolded, and therefore withdrawing that money in the month of September?
Well, that makes sense up to a point, but the point is that in credit funds, you don't see this kind of short-term inflow outflows. Typically, investors stay for years, not measured in the inflows and outflows are not measured in days. So that kind of short-term flows are usually seen in liquid and other very short duration products, the ultra short or low duration type funds, where you do see larger movements in space of maybe days or weeks. So my expectation is that this is just, you had a lot of liquidity perhaps in July or August, which led to inflows coming into these schemes, and then we have seen that kind of pulled back. The credit market conditions, of course, would have led to some concerns with some investors. I don't see the September closing as unusual. We'll have to wait and see whether the inflows resume this month. It's often the case that maybe first 1 or 2 days, not necessarily indicative of the whole month. But my expectation is things are normalizing. We have seen trades beginning to happen in the NBFC space, etc. So it's not that the markets are shut. I think it's just taking a few weeks for the entire market to settle down.
I was about to ask you that as my next question. You kind of preempted it. Conversations seem to suggest that after the first 1 week of a bit of a no-show, there are reasonably large number of conversations and trades happening in the last 2 or 3 sessions. What's been the experience at your fund? What's been the experience amongst your peers that you might be talking to as well?
Well, I think broadly for the markets, the most important thing is that just the noise dies down a little bit. I think there was this fear that, especially after ILFS, maybe a month or now close to a month and a half ago, that this issue could just spread and become systemic. Clearly, what the last few weeks tells us is that these are idiosyncratic, which is to say, affects one company or one group, and it is not a systemic problem of liquidity or credit events. and therefore it takes a little bit of time, maybe a week or two, for this noise to die down and then the markets start functioning again. We must also remember that absolute overnight liquidity is still plentiful. So we have the overnight rate, the CBLO rate as we say, is trading at maybe about 6/4, 6.30 against the official repo rate of 6.5, which suggests that at least overnight liquidity is plentiful. It just needs to move from just the overnight cash into money markets, and I think that transition is happening in the last couple of days, and my expectation is it will continue to happen.
Siva, we did see reasonably large-scale redemptions, not necessarily at Axis MF, but at the other mutual funds in the month of September, with reason, of course. I'm not saying that was without reason. My question is that behavior continuing in the month of October, wherein redemptions have been large in mutual funds, or you think that fearful redemption behavior is no longer there?
See, the first flush fear has played out, and in the sense of, at least in terms of whatever outflows we should have seen, which means that those who were, shall we say, reacting to news or reacting to rumors have acted also. We're not seeing any sort of follow-up. Obviously, like I said, it's not like there are any further credit events in the market. So what that means is that things are kind of calming down, and it will take something else, a new trigger, if we were to really see outflows. What we see right now is, yes, there might be a small flight to safety, so you might see money moving from higher risk products into lower risk products. That's normal when you have an event like this. But eventually, we see that, despite these rating actions or these credit events, what you see is that it's, again, I come back to the point that it is not systemic, and funds which are not exposed or ones which have low exposure to high risk entities will continue to see flows. We've seen this time and again in the past.
Okay, one final question on this topic, and then I have probably one on rates. But my conversations with some of the AMCs seem to suggest that for a select few NBFCs, they are not keen on rolling over the paper on maturity. I mean, without getting into names, but kind of figure out what those 2 or 3 entities would be. My question to you is, do you believe that AMCs by and large would, for lack of a better word, shun the papers of a lot of the NBFCs, or is it restricted to about 3 or 4 wherein there could be fears, but the papers of some of the other NBFCs, even at a better rate, of course, would find acceptance in the mutual funds?
Sure. What you see over the last couple of days is that rates and spreads are almost back to normal. So first of all, the markets kind of come back. But what you also need to remember that there will be some reduced rollover of the CPs this time around, simply because AUMs have fallen and they have not probably gone back to previous peak. So to that extent, if I had X AUM and I'm down maybe 10 or 15%, then I will need to roll over 10 or 15% less this quarter. So that's fair. My expectation is that it will be less of a rollover. The second thing is, a lot of NBFC borrowing, and not just NBFC, many corporates who borrow in the CP market do so because they have a rate advantage to borrowing from a bank. Now, if CP rates go up in the market, that it makes sense for them to borrow from a bank, they will just switch borrowing. They are not going to pay higher rates in CP market just to access the CP market. The CP market acts as a low-cost borrowing mechanism for these entities. The moment the CP market stops offering that lower cost, it makes sense for all of these entities to go back to other forms of financing. So I think there will be some of that substitution. You will see maybe a drop in CP issuance and higher bank finance in the near term.
Would the RBI's comment also lead to that, Siva? And that was my question really, because I think the views of the market is split in 2 ways as to what Viral Acharya and then the other Deputy Governor had to say with regards to the ALM mismatches. But I thought that the conversation or the comment was largely for NBFCs which are borrowing short, lending short, and long, predominantly in the infrastructure space. What did you make of that? And does that alter the landscape for NBFC lending in a meaningful way? Or is it only restricted to a select bunch of non-banking financial companies, predominantly in the infrastructure financing space?
I would think the reaction is exactly from that point of view, that they don't want to see infrastructure financing. You don't build a road by financing using commercial paper. But we don't see that from most of the NBFCs. We do see reasonable asset liability matching. Of course, there will be some mismatches, and if RBI steps in to correct that, then it's very good from a debt investor's perspective, of course. I can't speak for equity markets, which may be disappointed because they love spreads, and therefore CP borrowing to lend long may give them higher spreads. But as a fixed income investor, as a bond investor, I'll be very happy to see lower risk coming from ALM mismatches. So this just is one step that RBI could easily take to reduce risk in the NBFC sector, and that's be very, very welcome from us. Of course, it might mean that the overall supply of CP may drop in favor of other long-term instruments, but that's fair. But we would really be happy to see if RBI steps in just to reduce risk in the debt markets.
Interesting. What's the view on rates, Siva? I mean, I'm guessing everybody was surprised with what the RBI did. We haven't had a chance to talk to you post that, but there is ample opinion out there about 2 more hikes in the next 2 meetings. What would be your base case view?
So our call has been that RBI is on a rate path, although we have maintained that they have some time on their hands. And what RBI demonstrated just now is they're using that time to reassess. They have put in 2 preemptive hikes already. That's not a small move. And now they have clearly said they are on a tightening path, which again is something I think consistent with what they have been doing over the last couple of policies. Now, having said that, one thing very clear that comes out to us is RBI is saying that the currency market cannot be the driver of rates. We saw the RBI move rates in response to a currency event in 2013. That was a spectacular failure. And then we've seen other countries in Asian region, for example, Indonesia, but also if you go further afield and look at Argentina, Argentina has raised rates to 60%. And yet their currency is the worst performing in this year. Interest rate, I think it's very wise of RBI in a sense to say that rates cannot be a tool to manage currency. So look at domestic factors. And what's happening on the domestic economy is inflation has been undershooting RBI projections for the last 3 months. They have a lot more confidence now that they may be able to keep inflation below 5%. And that's giving them some room to pause on rates to see how the inflation trajectory evolves. And I think it's good that RBI sees it from this angle. We must remember that in the medium term, that is to say when you measure in years, currency is driven more by growth than by rates. And if RBI takes care of financial conditions and ensures that growth is there, with low inflation that is, then overall we should be very happy with the rupee performance 12 months or 24 months down the road.